Okay, let's move on to the next topic of our agenda today. What I'd like you all to spend some time right now doing is get into a mindset where you think in terms of every incremental expense that you make in the business as an investment. And to go through a little exercise of thinking, how am I going to get an appropriate return on that investment? Whether it's spending money for an advertising campaign, or a new piece of equipment that'll cut down on your cost of production, or hiring a new person. So let's go through a couple of examples that I've already prepared here. Let's say you're thinking about buying a new machine that's going to cut down on your cost of production. Your sales right now are running $1 million a year, and your cost of goods sold are about $500,000, so you have a 50% profit margin. So your gross profits are $500,000 right now. After the machine is purchased, your sales aren't going to go up. Purchase of a new machine doesn't increase sales, but your cost of goods sold are going to drop from $500,000 down to $450,000. So your gross profit margin will rise from $500,000 to $550,000. So there's a $50,000 of new cash flow that'll come in as a result of this purchase. Is it a good investment? Well, the answer is I don't know yet, because I don't know how much money I need to fork out in order to get an extra $50,000 coming in. So let's say, for example, that the machine costs you $50,000. You don't have $50,000, and a bank won't lend you money right now, but you can borrow money from a hard money lender at 20% interest rate. So at 20%, your interest expense the first year is going to be $10,000. In addition, at the end of the first year, the lender is going to want back $10,000 of principal, so your total cash outflow in year one is going to be $20,000. $10,000 in interest and another $10,000 in principal payments back. So you've got to fork out $20,000 in order to make $50,000. That's a pretty good return on your investment. I'd be very comfortable with that. So the answer to the question, should I buy this new piece of equipment? I would suggest the answer is definitely yes. Let's look at another example. Let's say that we're considering an advertising campaign. Same situation here. We've got sales of $1 million and gross profits of $500,000. But we think the ad campaign is going to increase our sales. It won't cut down on our cost of sales. We still have a 50% gross profit margin. So after the ad campaign, our sales will be $1,050,000, but our cost of goods sold go up because it's not from $500,000 to $525,000 because it's still 50%. So we increase our profits here from $500,000 to $525,000. We have an extra $25,000 coming in. Let's say, however, that ad campaign is going to cost $50,000, just like in the first example. You're going to borrow the money at 20%, and we're going to have to pay back $10,000 at the end of the year. So you're going to have $20,000 going out the first year, just like in the previous example. But in this case, to only increase your cash flow by $25,000. Should you spend $20,000 to increase your profits by $25,000? I'm going to suggest the answer is no. We got to realize that this is really just an estimate. We don't know how much the ad campaign is going to bring in. And sometimes we tend to estimate those things too high. So I would suggest you have a buffer in here. Give yourself a rule of thumb that says, I should be able to make in the first year at least 2 times the amount of money that I need to put out in the first year in order to make it a good investment. That's the kind of rule of thumb thinking that you should start thinking about as you start to spend money, as you start thinking about bringing on additional people, as you think about machinery, etc. If you do that, you'll be able to control your costs better, increase your revenues better, and increase the profitability of the overall firm at a much more rapid rate.